Welcome, everyone. My name is Andrew. I'm the founder and owner of IBIS Prep, and tonight we are continuing the February 2026 complete course for the Florida bar exam, and we're going to work on business entities. Business entities is a very tough subject, and statistically speaking, it's likely to be tested on the upcoming exam because it wasn't tested last administration, and it's very rare that they don't test a Florida multiple choice section in back-to-back administration. So you can expect this subject to be tested, not guaranteed, but it can be expected. So the first thing I'm going to do is start with the little foundational quiz that I have on Birdie. And again, on Saturday, we'll do the remaining 50 and we'll do the secured transactions commercial play. We're going to do 150 questions, hopefully, on Saturdays. Maybe we can get through. But I'm going to start tonight with just the foundational review to kind of get things rolling. Okay, so a Florida corporation's articles of incorporation require that directors receive at least 48 hours written notice before any special board meeting. Years later, the corporation adopts bylaws stating directors may hold special meetings without notice if all directors customarily meet weekly. The directors continue to meet weekly, but the chair calls a special meeting with no notice to approve a major acquisition. One director objects, arguing the meeting is invalid because there was no notice. Will the articles of incorporation or bylaws prevail? So this is a fundamental idea that the articles of incorporation will prevail over the bylaws because the articles of incorporation are filed with the state, they're foundational, and they're prevailing. The bylaws are more internal. So here, the articles control because they prevail over conflicting bylaws would be the best answer. If articles conflict with bylaws, the articles always govern. A Florida corporation's articles state the corporation's purpose is to operate a chain of retail bookstores within Florida. Without amending the articles, the board authorizes the purchase of a commercial airplane to begin offering tourist flights in another state. A shareholder challenges the decision as an ultra vires act. What constitutes an ultra vires act? So they're just asking what's ultra vires. Ultra vires means outside of the authority granted in the articles. Literally, what B is saying that if you do something, the articles said to do bookstores, and here you're buying an airplane, there's a strong argument there's an ultra vires act, which is outside of the authority granted to them in the articles. So ultra vires means the corporation acted beyond the powers or purpose stated in its articles, even if the act itself is lawful. Which define best defines a proxy? So a proxy is a remote vote. A proxy is, hey, I'm going to be in, Singapore, but I want you to vote in the company's meeting. So I authorize you either written or electronically to vote for me. So a written or electronic authorization allowing someone else to vote a shareholder's shares will constitute a proxy. Why does cumulative voting benefit minority shareholders? Unfortunately, they make you do some math on the business entity section of the Florida bar exam. I remember having to do it myself when I took the test. So cumulative voting as opposed to straight voting means if you have 10 shares in a company, you're a common stockholder, you get 10 votes for the board of directors, right? So if there's 5 directors running, you get 2 votes per director, right? You have 10 votes, there's 5 directors, you get 2 per. Now, if they allow for cumulative voting, that allows you to stack your votes for any one individual candidate. So you can, instead of voting 2 for all 5 open positions, you can vote 10 for one position. And that benefits minority shareholders because it allows you to concentrate your votes on one candidate. So if all the, people stack their votes cumulatively for someone who represents their interests, it does allow them to have a particular say in the company. So cumulative voting is stacking all your votes for a singular candidate. Cumulative voting helps minority shareholders by allowing them to concentrate all their votes on one candidate to secure representation. The Articles of Incorporation and bylaws of a Florida corporation say nothing about director compensation. The board, by majority vote, approves a substantial increase in directors' annual compensation. A shareholder challenges the action, arguing that directors cannot vote themselves raises without shareholder approval, which is correct. The board, because directors may set their own compensation unless the articles or bylaws provide otherwise. That's the truth, right? The directors may set their own compensation unless the articles or bylaws provide otherwise. It's just a true statement of law. That's going to be the best answer here. By default, directors in Florida may set their own compensation unless the governing documents restrict that power. At a duly called shareholder meeting, the shareholders of a Florida corporation vote to remove a director before the end of her term. The director sues for reinstatement, arguing that she is not engaged in misconduct and therefore can only be removed for cause. The articles and bylaws are silent on removal standards. How should a court rule? In favor of the shareholders because directors serve purely at shareholder will. In favor of shareholders because directors may be removed with or without cause unless the articles restrict removal. That's a better answer right there. That just like the last one, they can set their own compensation unless the founding documents say, or the governing documents say differently. It's the same thing with removal. They serve at the pleasure of the shareholders and they can be removed with or without cause unless the articles restrict removal. In Florida, shareholders may remove directors with or without cause unless the articles specifically limit removal for cause. A shareholder of a Florida corporation sends a letter to the board directing the board to fire the company's CFO and immediately declare a cash dividend, arguing that as an owner, he has the right to dictate these major decisions. The board refuses both demands. The shareholder claims the refusal violates the ownership rights. Who is correct? So here, can a shareholder demand that dividends are declared? The answer is no. Dividends are declared by the BOD, the board of directors. When the company is profitable, they declare dividends, but there's no right to demand dividends. So I like this answer C here. The board, because shareholders have no statutory right to manage the business or demand dividends. Shareholders are essentially investors in the company that have an ownership stake and are entitled to dividends when declared. When dividends are declared, they're going to go to preferred shareholders first. And once preferred have received their stated dividends, then any leftover dividends can be apportioned to the common shareholders. So dividends, when declared, and they first will go to preferred shareholders. That's what preferred shareholder means, that you have dividend priority. They also will have liquidation priority in the event of a liquidation event. And common shareholders have voting rights and more substantial rights to vote on different matters than preferred shareholders. And preferred shareholders have dividend priority and liquidation priority. So shareholders do not manage corporate operations and cannot compel the board to declare dividends, right? They can receive them when declared. Two equal 50-50 shareholders in a closely held Florida corporation cannot agree on electing directors. Each refuses to vote for any candidate supported by the other. As a result, the corporation has been unable to elect a board for over a year and cannot carry on major corporate functions. That constitutes a deadlock. One shareholder petitions for judicial dissolution based on a deadlock. Is dissolution available on these facts? Yes. In a closely held corporation, that's a really small corporation, if there is a deadlock, then that would be judicial grounds for dissolution. So yes, because shareholder deadlock preventing the election of directors is a statutory ground for dissolution. Shareholder deadlock that prevents director elections and impairs corporate functioning is a recognized ground for judicial dissolution in Florida. A Florida LLC's manager has been diverting company funds to operate an illegal sports betting ring. The LLC's operating agreement provides that no member shall ever have the right to seek judicial dissolution of the company for any reason. A minority member petitions a Florida court for judicial dissolution based solely on the manager's unlawful activities. The LLC argues the operating agreement bars the petition. What's your result? So here they're doing illegal things. They're going to be adequately dissolved because you cannot carry on an illegal purpose. So the petition may proceed because unlawful conduct cannot be waived since the statutory ground for judicial dissolution. So a deadlock in a closely held corporation is grounds for dissolution judicially, and also unlawful conduct would be grounds for judicial dissolution. A visitor slips on a wet floor and is injured while on property owned by Seabreeze LLC, a Florida limited liability company. The visitor sues both Seabreeze LLC and one of its members, Alex, personally. Alex owns 30% of the LLC but had no involvement in the property's maintenance and no personal role in the incident. The visitor argues that Alex is personally liable as an owner of the company. Under Florida law, what result? So remember, this is an LLC. An LLC is like a C Corp or an S Corp or an LLP where it's limited liability. So the individuals don't have personal liability here. So Alex is personally liable? No. Alex is not personally liable? Yes. Because the LLC's debts and liabilities belong solely to the LLC. That's a fact, right? They're a limited liability company. IBIS Prep is an LLC, right? I'm not personally liable for whatever shenanigans could happen. Nothing, right? We're a nice little tutoring company. But in the event that something did happen, I wouldn't be personally liable, right? Your president, right? President Trump, he went bankrupt a few times, but he didn't go bankrupt. His LLCs went bankrupt. So they weren't able to collect from him personally. They were just able to dissolve his LLCs. It's kind of like, you guys wanted a businessman to be president. That's kind of guy you get, right? LLC members are not personally liable for the LLC's debts and torts simply because they're members. Liability ordinarily stops at any level. And I don't care about politics. Don't make this like I hate the president thing. I just don't care about politics. All right, Driftwood Solutions LLCs files articles of organization in Florida that, so remember, LLCs are articles of organization. Corporations are articles of incorporation, kind of like a subtle difference that do not specify whether the LLC is member managed or manager managed. So if they don't specify, it's going to be member managed. IBIS Prep LLC is a single member LLC. You're looking at him right here in the flesh. I manage the company, right? But if I appointed Alexis and James and Bianca to manage it, then it could be manager managed. But the assumption is member managed. The members never adopt an operating agreement and no manager is formally appointed. The business begins operating and enters into contracts with third parties. A vendor asks who has authority to bind the LLC in the ordinary course of business. Under Florida law, who manages and has authority to act for the LLC? So all members, because Florida LLCs are member managed by default unless otherwise stated, right? If they state that they're manager managed, then it would have to be clearly opted into via the articles of incorporation or operating agreement. So in Florida, LLCs are member managed by default unless the articles or operating agreement clearly opt into manager management. So we assume member managed LLC unless there's a clear indication that they've opted into a manager management position or situation. So after deciding to dissolve, Palmetto 3 LLC begins the winding up process. One member insists that the LLC should immediately distribute all assets to members. Another member argues that the LLC must first satisfy or make provisions for its debts and other liabilities and properly close its affairs before distributing residual assets. Under Florida's mandatory winding up rules, which statement is correct? So in liquidation, you got to pay off all your debtors, creditors, taxes, employees. Like common shareholders have junior liquidation priority. Preferred has above common, but even preferred, they're not going to get paid out until, they've made provisions for its debts, they settled and closed its affairs, and then they marshal and distribute its assets after the fact. So that's going to be the best answer here that, first we need to settle our debts before we're going to distribute remaining assets to the members. Three friends begin operating a lawn care business in Florida, mowing lawns on weekends and sharing profits equally. They never sign a written agreement and never file any paperwork with the state. After a customer is injured by a lawnmower, the friends claim that they intended to form a limited partnership so that only business assets would be exposed, not their personal assets. The injured customer argues they formed a general partnership. Under Florida law, which result is correct? They formed a limited partnership because their subjective intent controls. They formed a limited partnership because conducting business together for property is sufficient. They're not a partnership because no written partnership agreement was executed. And they formed a general partnership because they carried on a business for profit as co-owners without filing a certificate of limited partnership. So here, yeah, they never signed a written agreement or anything. We're just going to assume that it's a general partnership. So that would be the assumption is two or more people doing business together for profit. We'll assume is a partnership. And the assumption is that it will be a general partnership. Harborline Partners is a Florida general partnership that routinely buys tugboats and marine equipment as part of its business. Without consulting the other partners, one partner, Mia, signs a contract to purchase another tugboat from a local dealer. This type of purchase is within the ordinary course of Harborline's business. When the partnership refuses to pay, the dealer sues the partnership and all general partners personally. The non-signing partners argue that Mia lacked authority to bind them. So Mia was a partner, she could definitely bind them, and she's going to bind the entire partnership. So only Mia is liable? No. Only the partner is liable. Non-signed partners are protected. The partnership is liable, and all general partners are personally liable for the partnership obligation. That's the facts, right? That's why you want to be an LLC. You want to be an S corp. You want to be an LLP. If you're just a general partnership or general partner, you risk personal liability. So each general partner can bind the partnership in the ordinary course of business, and all general partners are personally liable for partnership obligations. Sunrise Solar Inc., a Georgia corporation, expands into Florida. It opens an office in Tampa, hires Florida employees, stores inventory in a Florida warehouse, and enters into multiple long-term installation contracts with Florida customers. Sunrise Solar does not obtain a certificate of authority to transact business in Florida. Okay, until you've obtained a certificate to transact business in Florida, you can be sued, but you can't sue, right? You can't maintain an action. So later, Florida customers sue Sunrise Solar in Florida court for breach of contract. Sunrise Solar moves to dismiss, arguing it cannot be sued in Florida because it's not authorized to do business in Florida. How should the court rule? They can be sued. They just can't maintain an action. So deny the motion because a foreign corporation that transacts business in Florida may be sued here, but might not maintain its own lawsuit until it obtains a certificate and pays any penalties. So quick and easy, no harm, no foul, right? That should have been a nice introduction to business entities. Definitely, we're going to do this 50 question quiz on Saturday, and there's a good amount of business entities questions in the mixed review, in the mini quiz, in the FBB practice questions, in the practice exam, and the final exam. So you'll definitely have more opportunities to do more questions. All right, Jeopardy, it's just one column, easy, um, easy column. So let's take a crack at it. Um, Yeah, and off the recording, we had Andy and Alexa, two amazing students. I'm so happy that they came in. And all of y'all who pass, I want you to come back and talk to my students. It really means a lot to me to have my former students come in and speak to the class and for me to see your continued success. It's what we do it for. Even though lawyers are never happy, right? If there's one thing lawyers will do, it's complain about everything they've ever wanted. But at least at least you have that. All right, so this has limited liability and is subject to double taxation. So I kind of showed you it's going to be a corporation, right? Corporations have limited liability and are subject to double taxation. Why double taxation? Because they're taxed at the corporate level as an entity, and then they're taxed personally when they sell their shares under capital gains taxes, right? Whereas an LLC or an S corp or an LLP or a partnership or anything else, that would have flow through taxation. You're only taxed at the individual level. The nice, for most of y'all who are starting businesses, and I've been in business officially as an LLC since 2019, we've always maintained an LLC status. It's a nice legal mechanism to have limited liability and flow through taxation. Very similar to an S corp. That would have limited liability and flow through taxation. That's kind of like the ideal scenario, unless you're a big ass company selling shares on the New York Stock Exchange or something like that. Hopefully, IBIS will get there one day, but one day. The partner who's personally liable. So again, this would be the general partner, right? Limited partners are not personally liable, whereas general partners are personally liable. A way to hold the BOD, the board of directors, personally liable for actions of a corporation. Anyone know what the answer to this one is? Let me see if anyone's chatting. Um, yeah, Beatrice said you'll be happy if you pass. I know you'll be happy when you pass, but wait until I ask you in 4 years if you're happy at your job at Smith and Johnson. It's a different question. Getting your results is always a happy moment. That's what people do the TikTok video, the happiest moment of their life. The practice of law is not the happiest profession. If you want to be happy in your profession, you should have been kindergarten teacher. Okay, so here we have piercing the corporate veil. We have usurping business opportunities. Okay, someone's saying derivative suit. Okay, a way to hold the BOD personally liable for actions of a corporation. I don't think it's a derivative suit, but you're close. A derivative suit is suing on behalf of the company to enforce rights. What if you're actually suing them um, yeah, okay. Actually, I think that piercing the corporate veil is actually a better answer here. Yeah, if you are going to hold the BOD personally liable for actions of corporation, you're piercing the corporate veil. If you're suing the corporation directly, it would be a direct suit. So I think actually, let's see who it was. Mary Carmen said piercing the corporate veil is probably the answer here. Yeah, piercing the corporate veil, which means you're either holding the board of directors personally liable or you're piercing a subsidiary company to you're going to pierce the subsidiary and go right to the parent company. That's called piercing the corporate veil. And Melissa, you said you're super happy as an attorney. I bet I can find you on a day where you're not super happy to be an attorney. It's when your clients are giving you uh, the ends of the earth. But listen, work is work. If it was not, it would be called play, right? That's why I should have been a baseball player. Acts by officers outside the scope of their authority. We already did this one. Um, we we would say that this is an ultra vires act. Yeah. And again, I know all you attorneys are claiming you love practicing the law. For all of you who haven't been attorneys yet, just remember what I told you. Uh, roses don't always smell like roses when you get that close. Okay. When a person cannot deny the existence of a partnership, so you can't deny it. What does that mean typically in contracts? Yeah, Melissa's trying to keep their hope alive. That sounds more right. Yeah. Um, yeah, lawyers get paid more than teachers. I'm not a career advisor. If I was going to give a young person career advice today, I'd say get into welding, get into electrician type work, get into something that AI is not going to replace because AI is a monster. Um, but whatever, do what makes you happy. Do what makes you happy. All right, that's a partnership by estoppel, right? It's a partnership by estoppel. Yeah, last thing I'm going to do is give you guys advice about anything but the bar exam. All right, so corporations. Makes sense. Good faith but improper filing of the articles of incorporation. What type of corporation would that be? It's not quite de jure. That's a good guess. Yeah, it's de facto. De jure means that it was properly filed. De facto means that was an improper filing of the articles of incorporation. So, Emily, you're the champion. You risked it all on Final Jeopardy and you got it right. Really amazing job. So that was a Jeopardy. All right, I got two PowerPoints to go through. You think I should do Katya's first or my PowerPoint first? Anyone have any ideas which one they want to do first? I don't mind. Katya's. All right, yeah. Let's do Katya's. So Katya's is in the chat, and we're gonna add this version to the classroom. For whatever reason, it like didn't download properly in the classroom, and there's some like overlap. But thankfully, Isabel was able to make it clear for us because you guys remember the Crim Pro one I did where I was like skipping over lines. Yeah, that was fun. So Katya definitely likes superheroes, I could tell. That's her thing. She's a superhero. Okay, so let's see. If I press play, can you guys see my screen? You can see Clark Kent. All right, so overview of business entities. And again, this is just medicinal. I'm going to just go through the PowerPoint, see what you had to say. Then I'll go through my PowerPoint. Then we'll do the questionnaire. I'm going to try and get through it quickly but thoroughly. So this presentation offers a comprehensive but focused breakdown of the most commonly tested rules regarding business organizations for the bar exam. We covered the fundamental legal frameworks, formation requirements, management structures, and liability issues for partnerships, LPs, corporations, and LLCs by Ekaterina Katya Cross Esquire. So partnership requirements. A person can be an individual or legal entity, right? Nike is a person in the world of business entities. Intent, at least two persons intend to co-own a for-profit business. No specific intent to form a partnership necessary. Commonly tested. Tommy and Johnny start selling lemonade on the street. They're in a partnership. Agreement can be applied by conduct, even if no written or oral agreement. The statute of frauds, a written contract is not required for formation, right? It's just two people carrying out business together. Extensive activity required beyond passive co-ownership. So, you have to be doing something to make money. The profit sharing test, profit sharing, there's a presumption of a partnership. Exceptions would be like debt payments, interest, loans, rent, wages, goodwill, retirement, or health benefits. That doesn't sound, none of that sounds fun like profit to me. So that wouldn't satisfy the profit sharing test. So the nature of a partnership, the person is a separate, or the partnership is a separate legal entity, meaning like, Tommy and Johnny are separate legally from T&J partnership, right? No protections. Partners are personally liable for the partnership's obligation, which is commonly tested, right? General partners are personally liable, but partnerships get passed through taxation, also known as flow-through taxation. A partner can commit the partnership to contracts. That's tested all the time. Like Johnny went out and bought the toilets. Well, P&J now own these toilets as a partnership. Fiduciary duty, so loyalty, no competition, adverse interest, or usurping opportunities. The exception is the partnership can designate some activities as not violating and provide safe harbor, but they cannot eliminate. So the usurping opportunities doctrine is like you have to give the partnership the opportunity to take advantage of it. If you say, hey, partnership, like there's a great opportunity in the partnership, like, nah, we're not interested, then you could pursue it personally, perhaps. But otherwise, they would be competing against your own partnership, which would be a violation of loyalty. Care, no gross negligence, recklessness, intentional misconduct, or no illegal violations. The partnership cannot unreasonably reduce this duty, and good faith must act honestly. The partnership cannot eliminate, but can give standards. So fiduciary duties of loyalty, care, and good faith. So profits, loss, and interest. So profits and losses. Oh, by the way, PA means the partnership agreement. The partnership agreement can designate some activity as not violating. The partnership agreement cannot unreasonably reduce this duty, or a partnership agreement cannot eliminate but give standards. Partnership agreements are, agreements between partners, but they're not necessary. Like we said, just Tommy and Johnny selling lemonade constitutes a partnership. Um, Profits, losses, and interest. So profits and losses, the partnership agreement governs, otherwise they're shared equally. Distributions are not demanded. Like I said earlier, if it's a corporation, then it would be upon declaration. Transfer of interest, the transferee gets the distributions, accounting dissolution. The transferor retains all rights and duties except for distribution. So if you transfer your interest in a partnership, you're just transferring the distributions, the profits, but you're not transferring necessarily all of the rights and duties. So property belongs to a partnership, not the individual partners. So that's something to definitely be aware of, that property belongs to the partnership, not the individual partners. So new partner requires unanimous consent of all existing partners. Management equal rights unless the partnership agreement states otherwise. And you need a majority vote for ordinary business and unanimous vote for extraordinary matters. And lawsuits, partners and the partnership can sue each other under on the partnership agreement or the Reformed Uniform Partnership Act, or the RUPA. The I don't know what that actually stands for. Now I'm thinking about it. The Uniform Partnership Act, let's just say. That would be true, that the partnership can sue a partner for violating a duty, or a partner can sue the partnership for, some issue. So the dissociation is a partner may voluntarily or involuntarily leave, but the partnership agreement cannot prevent the partner from withdrawing, but can require notice in writing. Sorry, I just need to move this. Okay. So partnership has unlimited by time or undertaking. So a partnership is unlimited by time or undertaking. Wrongful only when is in breach of an express provision of the partnership agreement for dissociation. A partnership for definite term or undertaking. A partner withdraws, expelled by court order, bankruptcy, not an individual trust or estate, and the partner dissolves or terminates. So these are reasons that would constitute wrongful dissociation, potentially, but a partner can dissociate at any time. They're still entitled to receive value of the partnership interest offset by any damages to the partnership. And the effect is it doesn't automatically cause dissolution, right? Like if, there's multiple partners, if there's three partners and one partner leaves, that wouldn't automatically dissolve the partnership. It would just be a dissociation. Dissociation is one person leaving the partnership. So partner as agent tested. So actual authority, apparent authority. There's actually something else called inherent authority, but actual authority means that you're explicitly or implicitly have the authority to contractually bind the partnership. And apparent authority means that a third party would reasonably believe that you had the authority to bind the partnership. Inherent authority means like inherently as your job. Like if you're the manager of a rock and roll band, then you have the inherent authority to bind that band to contracts, right? But actual authorities, if it's expressly in the partnership agreement or a partner states it, or implicitly that like this is something that they would have the authority to bind. And then apparent authority is maybe they lack authority, but a third party wouldn't know that. And so you will be bound, the partnership will be bound by the contracts of the partner. And then also there's a concept of ratification, even if it's, something they did not have authority to do. If, the proper person ratifies that conduct, that would be even more reason why they would be bound. So that's GPs, limited partnerships. So limited partnerships are formed with at least one general partner and one limited partner. The limited partners, no binding authority, no personal liability, even if participating in management, approval rights on amending the partnership agreement and making partners, etc., the right to inspect business financial records and contract businesses with LP like a non-partner. Where general partner has full management rights, they can bind the LP and responsible for liability. So just thinking about it, limited partners are not personally liable, whereas general partners are personally liable. Limited partner, my liability is limited to my investment. General partner, I have unlimited liability for the partnership's obligations, right? Nice little comic. Um, so promoter liability, corporate formation, the corporation is born. So, sorry, just need to admit a student real quick. Um, okay, so let's go back to play. Okay, so a promoter is someone who, tries to sell to form the company and sell the shares and get things underway. They have personal liability pre-incorporation, a fiduciary duty to the corporation, and they make seek compensation, but they cannot compel the corporation. So corporation liability, they're not liable for pre-incorporation transactions, even if they are for the corporation's benefit. Exceptions, the corporation adopted a contract by accepting benefits, they gave express acceptance of liability for the debt or a novation. The corporation assumed liability for promoter's contract and another party agreed to release the promoter from liability. So that just means that promoters can be liable for pre-incorporation contracts and they can still be liable post-incorporation unless there's been a novation to take the promoter off the hook. So think of a promoter as someone who, works to sell the shares of the company when it's being incorporated. In Florida, all corps are treated as C corps unless an election is made. The election would be to be an S corp. An S corp would elect flow-through taxation. So think of an S corp very similar to an LLC. It has flow-through taxation and it has limited liability. It's a top-down approach. You start as a C corp, you elect flow-through taxation, where an LLC starts as a sole proprietorship or partnership and elects limited liability. But S corps and LLCs pretty much end up in the same universe, which is limited liability and flow through taxation. I said the word universe there because like comic book universe. Okay, so articles of incorporation. Remember, LLCs have articles of organization. Corporations will have articles of incorporation. They test this a good amount. They must include the key info, the corporation name, the address of the principal office, the number and classes of shares authorized to issue, the agent, the name of each incorporator, and addresses of initial registered officers, and it's filed with the state. No stock is issued. The board of directors can amend the articles. If the stock is issued, the board of directors adopts amendment of articles, which shareholders must approve by majority, right? Like once shares have been issued, then amending the articles of incorporation would constitute a fundamental corporate change, and that would necessitate a shareholder vote. Shareholders get to vote on fundamental corporate changes, stock splits, mergers and acquisitions, electing the board of directors. Those are things that common shareholders do get to vote on. So amending the articles of incorporation would take a majority vote from the common shareholders. And then bylaws, provisions for management of corporation's business must align with the articles. Articles of incorporation generally take precedence over bylaws. We did a practice question that said just that. So organization reporting, so organizational meeting, the board of directors adopts bylaws and appoints officers, right, at the organizational meeting. And then annual reporting, you must file with the state, the name, the date of incorporation, the principal office location, the tax ID number, the name and addresses of all principal officers, directors, and registered agent. Failure to report can dissolve corporation and bar from bringing court action. So that's the organization reporting of a corporation. Stocks and distribution. So stock types. Common is basic ownership interest, voting on corporate governance. If you were to go out today and buy stock, um, I don't know what stock. If you like AI, I would say look into CoreWeave. Anyone know that company? They make the little tiny chips that NVIDIA uses, that Microsoft uses, whatever. They've gone up and down, but I feel like if you believe in AI, they're kind of like at the bottom of that. Obviously, NVIDIA, it would have been nice to invest in 5 years ago. Whatever. I'm not here to give stock advice, but common stock ownership means like you own shares of the company. Preferred stock too. It's an equity instrument. You own shares of the company, but you don't have voting rights. You have, like I said, dividend priority and liquidation priority. Fractional shares of stocks are allowed, right? A lot of companies these days are issuing fractional shares like Robinhood and I don't know. I don't know what the kids are using these days, but you can buy fractional shares. Distributions authorized by the board of directors must not cause insolvency, right? Like you can't give out dividends if you don't have any profit. Sales, so shareholders can sell stock to anyone at any price. Usually there's no liquidity risk of common stock if the company is traded on the open market, on the New York Stock Exchange or NASDAQ or something, because there's designated market makers who stand on the stock floor, the Wall Street floor ready to buy and sell. And if you list your stock, like my house is for sale right now, there's definitely liquidity risk in real estate. No one's gonna buy it. It's a down market, I guess. But like a stock, if I listed my Nvidia stock for sale, trust me, it'll get bought in an instant because you can buy and sell it on the open market for, not like penny stocks, not tiny stocks, or not like, closely held corporations or whatever. But for big stocks, there's no liquidity risk because you can just sell it on the open market. So stockholders get the strong liability protections, but corporations get double taxation. Once at the corporate level and again on dividends, right? Yeah, because dividends, capital gains tax. If you sell your shares, again, you have to pay capital gains tax. I mean, dividends will actually probably be taxed as ordinary income, whereas selling your shares after appreciation would be taxed as capital gains tax. Either way, Uncle Sam's getting into your pockets, right? You're going to be taxed at the personal level and you're taxed at the corporate level, meaning like before the company declared dividends, they had to pay their taxes. The distributions the corporation makes are after they've paid their taxes. So that's why we call it double taxation when it comes to a corporation, specifically a C corporation. An S corporation elects flow through taxation. So shareholder meetings, annual meetings, time and date, and bylaws, mainly to elect directors. Special meetings are caused by a board of directors or 10% shareholders. They must state the purpose in the notice. And notice shareholders must be notified of date, time, and place 10 to 60 days prior. Can be waived in writing or by attending the meeting. Lack of meetings doesn't affect the corporation's existence, right? Like you're supposed to have meetings, but if you don't, Nike's still gonna Nike, right? Voting and approval. So eligibility, record owners, owner stock at the COB on the record date set by the DB. Record owners, owner of stock at the, I wish you would have not put acronyms here. Um, I don't know exactly what those acronyms stand for, but it just means that, people who get to vote, you have to own stock at the time that there's a vote, right? Like if you uh, got stock later, then you wouldn't be able to vote. I think someone's trying to help me in the chat. Let's see. Um, Close of business. Okay, yeah, I like that. Close of business. Okay. All right. By the close of business on the record date set by the director's board or something like that. I mean, again, I teach for the Series 7 and 66, so I go not too deep with y'all because I don't want to get into like this is tough, like all this declaration date and payment date is stuff that's not tested. So I'm not going to get too deep into it. So the corporation cannot vote on its own stock. In sale of substantially all of corporation's assets outside regular course of business, the shareholders must approve the sale, tested. Yeah, that's a liquidation event. If they're selling, if it says, Nike only owns footballs and they're going to sell all their footballs, well, the shareholders get to vote on that because that's a liquidation event, which is a major fundamental corporate change. So approval requirements, general majority unless articles allow plurality, and election of directors, the default is plurality. So usually you need what's known as a quorum. A quorum is the amount of voters needed to hold a vote. And typically it's just a majority of the voters. So yeah, this is the question. M Corp's only assets are machines now in storage. One of its directors approached by a party interested in buying all the machines. What is true? We're going to need a vote here because it's all of the machines. It's their only assets. So majority of shareholders entitled to vote on the matter must vote in favor before M Corp can sell the machinery, right? So that's B. You're going to need a majority vote. All right, piercing the corporate veil. So the corporation's existence ignored. The shareholders become personally liable. Florida requires fraud, improper conduct, or illegality, right? There's different reasons you could pierce the corporate veil. Maybe there's an alter ego. Maybe there's an improper purpose. Maybe there's inadequate funding. Maybe it's the deep rock doctrine. Some reason why you would be able to go directly after the owners, the board of directors, the shareholders, or the parent company if the facts align with piercing the corporate veil. So totality of the circumstances. Florida focused on whether corporation was used to mislead creditors or perpetuate fraud. The fact that C is a mere instrumentality of shareholders is not alone sufficient to pierce the veil. There has to be some improper conduct, fraud, or usually a conduit for improper activity. If anyone went to University of Miami and had Professor Alfieri, he made y'all read the uh what's that book called? the Blue something River book. I can't even remember what the book is called, but it's a book about how this company was dumping sludge into a river and they were able to pierce the corporate veil and go after the parent company directly under that theory. I can't believe I forget what that book's called. Told you, you don't learn anything in law school. Um, It'll come to me. So, shareholder liability, piercing the corporate veil. Factors considered are undercapitalization, disregard of corporate formalities, using corporation's assets as shareholders' own assets, self-dealing with the corporation, siphoning the corporation's funds, using corporate form to avoid statutory requirements, shareholder domination of the corporation, fraudulent dealings with the corporate creditor. Like I said, the alter ego doctrine. The court may disregard the corporate entity when corporation appears to be the alter ego of the shareholders or subsidiaries. The parent corporation may be liable for debts of subsidiary corp when subsidiaries inadequately capitalized or intermingle with the parent corporation. So if IBIS Corporation set up a subsidiary and then that subsidiary was just doing tons of improper stuff, and then you try to sue the subsidiary and we're like, oh, well, we don't have any money, they'd be able to pierce the subsidiary and go after IBIS, who, by the way, doesn't have that much money either. But we probably have a little bit more money than the subsidiary company, and that would allow for piercing the corporate veil. So the board of directors, the composition, at least one director. You only need one director. The directors must be natural persons. So remember, a partner could be a corporation who counts as a person. But for a board of directors, it has to be a natural person. It has to be Elon Musk. It can't be SpaceX or whatever. Directors are elected at annual shareholders meeting. Terms removal, usually 1 year, but can be longer if the defendant's terms are staggered. Removable by shareholders with or without cause, unless the articles say otherwise. Vacancies, the directors may resign anytime with written notice to the board of directors or its chair. Can be filled by the shareholders or directors. The duties of directors, we said duty of care, duty of loyalty. So duty of care is to act prudently. So as an ordinarily prudent person in like position, required to use the knowledge and special skills they possess, the defendant can rely on info and opinions of owners, employees, lawyers, or experts. Um, Business judgment rule. So rebuttal presumption that defendant reasonably believes his actions were in the best interest of the corporation. This does not apply when the director engages in conflict of interest transaction with the corporation. So the business judgment rule means like typically businesses, and I know this because I own a business, a lot of times we're stuck between a rock and a hard place. Either we crash into the tree or we crash into the wall. I gotta go left or right here. So I crash into the tree. So from the outside, people are like, oh, well, business. It's like, no, I made the best decision I can make under the circumstances. And unless you can show, some conflict of interest or some, really improper rationale, then I'll be protected just because the outcome wasn't positive. We have to protect uh, business people and allow them to make business decisions without fearing repercussion for the outcomes. So overcome bad faith, not informed, material interest, fail to devote attention, did not investigate, receive financial benefits not entitled to, right? That's how you can overcome the BJR, business judgment rule. The duty of loyalty, the defendant has to act in a manner that the defendant reasonably believes is in the best interest of the corporation. Competition with the corporation is not allowed. Self-dealing, if engages in conflict of interest transaction with the corporation, it's violated the duty unless the transaction is protected under the safe harbor rule. Disclosure of all material facts and majority approval by board of directors or shareholders without conflicting interest. A defendant cannot profit at C's expense. So usually when you hear the concept of a disinterested member, it means someone who doesn't have an interest, someone who, if let's say, you work for Nike and you're saying, oh, we should acquire this piece of property for a new football field. And it's like, okay, but the people who are going to develop the property, you're an owner of their construction company. Well, you would be an interested person, so you wouldn't be able to vote in that decision. You have to be disinterested and not have a stake in it. That's what disinterested means, no stake in the matter. And then usurpation of corporate opportunity, interest expectancy test, whether the corporation has existing interest or expectancy arising from existing right and opportunity, and the line of business test, where the opportunities within the corporation's current or prospective line of business, you have a duty not to usurp corporate opportunities. So mergers require approval, documentation, liability. So approval, each corporation needs board director and shareholder approval by a majority of the shares entitled to vote. Documentation are the required documents which must be filed with the state. And liability, the surviving corporation assumes liability of the corporation that is merged. So a merger usually means that there's going to be a surviving and a target corporation, right? There's a lot of different forms of mergers. There's like triangular mergers, there's short firm mergers, but typically it's when two companies uh, merge together and one survives. So the articles of incorporation for number one corporation granted to its board of directors the power to take any actions authorized by law. Which of the following actions by the board of directors must also be approved by shareholders of number one corporation? So a merger, literally, B, merger. If there's a merger, then we need shareholder approval because a merger is a fundamental corporate change, right? LLC, so like I told you, my company's an LLC, combines the pass-through tax advantage of a partnership and the limited liability of a corporation. So formation, the signing and delivering the articles of organization, Department of State, they must state the LLC name, the address of principal office, the name, address, and written acceptance of the registered agent. We usually have an operating agreement, which can override statute unless for key governance like registered agents, dissolutions, mergers, indemnities, rights, obligations of members and managers. Membership, they must have one member at formation. And remember, there's member managed and manager managed. And like I said, we assume they're member managed unless they elect a manager managed situation. So LLCs, the member managers are not personally liable for LLC's obligation. They owe a duty of reasonable care, fiduciary duty, duty of loyalty, duty to avoid conflicts of interest, and veil piercing applies in egregious cases. Egregious cases. No one's piercing Ibis Prep to come after me. I have even less assets than Ibis Prep has. We're running slim here. So assignment of membership. Transferee only gets transfers right to share in the LLC's profits and losses. Single member LLCs, like my company, the creditor can obtain a charging order, making him the assignee of members' distributions and foreclose on the member's interest. That doesn't sound like a good thing. And then multi-member LLCs, creditor can only obtain charging order, may not foreclose. Unless the articles provide otherwise, members have a non-waivable right to dissociate from the LLC at any time. A and D form an LLC and the only members. Andrew contributes a tract of commercial real estate to LLC. Donna contributes 150,000, which is true. The LLC is the sole owner of the commercial real estate and any property that's acquired with the $150,000, right? The LLC owns the property, so C is going to be the best answer here. Questions? You can holla at Katarina, Katya Cross, Esquire. Please don't text her. If you watch this on YouTube, please don't text her. That's not that move. Send her an email. Okay, so without further ado, let's see. Close of business. Yeah, I think that's what COB stood for. All right, now I'm going to hit you with my PowerPoint. I think that one was probably more enjoyable. Mine is more like I have a hard time teaching business entities, like I said, because I kind of know too much because I teach for the securities exams, which they test so much further in depth than this. And it's not a legal test, it's a securities test. So, I know some things that you guys don't need to know, and I kind of forget when I need to stop telling you all that. But, the more you know in life, the more you know. All right. So I appreciate y'all for staying strapped in, ready to rock. Let's see what I got. So, Florida Bar business entities. See, this is my business line. You can text that all you want. Send donations too, right? We are accepting donations. All right, Florida C corporations. A C corporation business expenses are tax deductible because C corps are already subject to double taxation. So they enjoy other tax advantages, such as being able to deduct business expenses that other types of corporations and businesses may not be able to deduct, right? So, I mean, that's definitely true. Companies like Alphabet, the owner of Google and Uber and these companies, if you look at their records, they claim to make no money. Uber's lost money every year it's ever been in existence, right? They deduct a lot. A C corporation allows for significant growth potential because stock associated with C corps can be sold freely with unlimited potential growth for these types of corporations. C corporations can have multiple stock types and unlimited amount of shareholders, whereas an S corporation only allows for one class of stock and a cap of 100 shareholders. So when people say why, people tell me to become an S corp, one of the main reasons differentiating an LLC and an S corp is S corps can issue shares, and there's some tax advantages for employees, but otherwise LLCs and S corps are pretty similar in the fact that they're flow through entities with limited liability. So C corporations protect from various liability issues because C corporations provide very limited liability for directors, shareholders, and employees and officers. A C corporation is subject to double taxation, the largest drawback. And there's no deduction of corporate losses is another disadvantage, and that shareholders are not able to deduct corporate losses on their taxes, whereas S corporation shareholders can deduct such losses, right? That's one of the benefits of flow through taxation for being an S corp. So corporate formation, we said anyone could be an incorporator, be a person or an entity. Articles of incorporation needed to say all these things like we talked about. They may include this, they must include that. The procedure, the incorporators deliver the articles to the Department of State. An organizational meeting after incorporation, the incorporators will hold an organizational meeting to complete the organization of the corp by appointing officers, adopting bylaws, etc. 2 days notice must be given to each director. And the bylaws, they may contain any provision for managing the business and regulating the affairs of the corporation. Remember, the AOI, Articles of Incorporation, will prevail over the bylaws. So types of imperfect formation. So de jure corporation, oh shoot, I didn't mean to click that link. How to start a Florida corporation. There you go. If anyone wants to get out of law and get into business. A de jure corporation has obtained a certificate of incorporation from the state. The de jure corporation definition is a corporation that has fully complied with the entirety of the state's incorporation requirements, meaning the company is bona fide corporation under state law. A de facto corporation have some legal protections, but not the full scope of Florida de jure corporations. For de facto corporation definition, state recognized de facto corporation, which incorporators made a good faith effort to comply with the state's incorporation statute, meaning they missed only technicalities. So maybe the AOI was defective. It didn't name the directors or the incorporators or something, but it still was a good faith effort. And then incorporation by estoppel refers to someone contracted and dealing with a business as if it were a corporation. In doing so, it's an admission that the entity is a corporation, and therefore a stop to deny its incorporation should an action arise out of the contract or course of dealing. So estoppel, we see, estoppel by deed in real property, or promissory estoppel in contracts. It's the same concept here, that you're stopped from denying your corporate status. So S corporations tax similar to LLC. An S corp does not pay any tax and thus avoids a double taxation of a standard corporation. Unlike an LLC, however, which pays tax on the entire net income of the business, an S corp is taxed only upon the wages of shareholders who are also employees. Any additional income is allocated to member shareholders' distribution. Distributions are taxed at a much lower rate than employment taxes. An S corp must meet with IRS formal administrative standards, which include regular director and shareholder meetings, adopt the bylaws, financial record maintenance, etc. For LLC owners, considering an S corp is nice because salaries and distributions, in order to avoid costly audits by the IRS. I mean, some regular advice. So Florida LLCs, a Florida LLC combines the liability protection of a corporation with the tax stream and ease of administration of a partnership. Forming an LLC in Florida offers pass-through taxation where the members report their share of the LLC's profits and losses on their individual tax returns. Any taxes then due at the individual level. In a member-managed LLC, members' owners are responsible for the LLC's day-to-day operations. In a manager-managed LLC, members appoint or hire a manager or managers to run the business. Whoever manages the LLC will be able to open and close bank accounts, hire and fire employees, and enter contracts and take out loans. So are LLCs corporations or partnerships? I mean, it's a legal fiction, honestly. An LLC is created by the IRS to elect into. An LLC is an entity created by state statute. Depending on elections made by the LLC and the number of members, the IRS will treat an LLC as a corporation, partnership, or as part of the owner's tax return, a disregard entity. That's how I file my taxes. IBIS Prep and me are one and the same for tax purposes. We disregard the entity. A domestic LLC with at least two members is classified as a partnership for federal income tax purposes. Unless it files a form, we treat it as a corporation. For income tax purposes, an LLC with only one member is treated as an entity disregarded as separate from its owner unless it files this form that I don't file and elects to be treated as a corporation. However, for purposes of employment tax and certain excise taxes, an LLC with only one member is considered a separate entity. So again, think of an LLC as a creature of the law that allows people to shield themselves from liability and to only pay taxes on the personal level. So piercing the corporate veil. So a corp may disregard a corporate entity or pierce the corporate veil in certain situations. Shareholders active in the business may be jointly and severally liable as if they were partners, but inactive shareholders are generally not liable. Motives for a court to disregard and pierce the corporate veil would be the alter ego doctrine. The court may disregard the corporate entity when the corporation appears to be the alter ego of the shareholders and used by them as a conduit for their personal affairs. Florida law requires a stronger and proper conduct. Thin capitalization. A corporation must have adequate capital to meet its reasonable and foreseeable needs. The deep rock doctrine means that, we're going to subordinate inside loans and pay off outside creditors first because of improper purpose, usually. So in bankruptcy proceedings, capital contributions that are denominated as loans by shareholders of closed corporations may be subordinated debts to outsiders. And then subsidiary corporations, a parent corporation may be liable for the debt of a subsidiary when the subsidiary is inadequately capitalized and intermingled with the parent or otherwise not a true distinct entity. So piercing the corporate veil, going after the parent company directly, going after the owners directly, and piercing the corporate veil. Equity securities. So common stock in Florida, the main common shareholder rights include voting power, ownership of the company, right to transfer ownership, right to dividends, right to inspect corporate books and records, and then the right to sue, derivative suits and direct suits. Remember, derivative suits are suing on behalf of the company, direct suits are suing the company. So preferred stock is stock with priority access to dividends. Whether preferred stock is cumulative or straight, non-cumulative, determines that the issuer must make up skip payments. If it's cumulative, the issuer must pay missed dividends to preferred shareholder stockholders at some point. If it's straight, the issuer will not make up skip dividends. So you hear this word cumulative twice in biz entities. Cumulative voting rights mean you can stack your votes for a single share. Cumulative preferred stock means that, let's say you have, stock in CoreWeave, right? You guys are all going to go out and buy that stock. Don't take my financial advice. AI might be a bubble, although they just bought AI.com for $100 million, so who knows? But .com bubble was the biggest bubble ever, so who knows? So anywho, let's say you buy CoreWeave stock, right? And you have preferred shares that pay a 4% dividend. What it means is that every year when dividends are declared, preferred stock needs to get their 4% before common stockholders can get paid. But what if preferred shareholders don't get paid? Well, if it's straight, then it doesn't matter. They don't get paid. The next year, they got to get paid 4% before common shareholders can get paid. If it's cumulative and they don't get paid, then the next year, they need to get paid not only the 4% that they're owed this year, but also for the year in arrears. So they would actually need to get paid 8% before common shareholders could get paid out. So that's the difference between cumulative preferred stock and straight preferred stock. Is cumulative preferred stock, preferred shareholders need to not only get paid this year's dividend payment, but also dividend payments in arrears before common shareholders can get paid out. Again, that might be outside the scope of the Florida bar exam, but the more you know, right? All right, debt security. So common shareholders have, shareholders have stocks, which are equity. You own the company. Debt means you've lent the company money with the expectation of being paid back your principal plus interest. So a bond is a debt obligation like an IOU. Investors who buy corporate bonds are lending money to the company issuing the bond. A debenture is a type of bond or other debt instrument that's unsecured by collateral. So it's like a junk bond. It's a very risky instrument. Debentures, risky instrument. A registered bond is a debt instrument whose bondholders' information is kept on record with the issuing party. And then a bearer bond is a fixed income security that's owned by the holder or bearer rather than by registered owner. So typically, if you guys have a mutual fund or you have a 401k or whatever, it's a mixed basket of stocks and bonds. Stocks are equity securities, ownership in the company for capital appreciation purposes, and then debt are income instruments that pay, interest, and they're safer. Preferred stock is kind of like an equity instrument because you have ownership with debt features because it pays dividends. So preferred stock is kind of like a mix of capital appreciation and income. And there's a whole universe I could discuss, but this is an investing class. This is a law class. So the order of liquidation of corporate assets. If a company is forced to liquidate its assets, it'll pay the liquidation funds in this order. So wages first, taxes, secured creditors, unsecured creditors, junior unsecured creditors, preferred stockholders, and common stockholders. You see, common stockholders have junior liquidation priority. A lot of you are probably out there like, oh, I would get preferred stock. They sound way better. Like they have dividends and they get higher liquidation priority. Yes and no. They also have less room for growth. Like everything is a pro and con. And again, if you decide you don't want to be a lawyer, you want to be a financial planner, a stockbroker, I can also tell you the grass is always greener, but we could have these conversations about why you would prefer these instruments. But just know that like just because it's called preferred stock doesn't mean it's the better thing to own. Most people own common stock. If you go out there tomorrow and buy stock in a company, you're buying common stock. Preferred stock is like a safer instrument that has income, but it'll cap your capital appreciation potential. Promoters. So a promoter undertakes to form a corporation and to procure the necessary capital and other items. Promoters must act in good faith in the best interest of all investors. A promoter who profits from a sale to the corporation may be liable to it for profits. Promoters remain liable on contracts they enter on behalf of the corporation, even after the corporation adopts the contract, unless the parties agree to a novation. The bar examiners often test on promoter liability. Remember that generally a promoter will be personally liable on a pre-incorporation contract unless the contract clearly negates personal liability, in which it will be treated as a continuing offer to the corporation. Even after the corporation is formed and adopts a pre-incorporation contract, the promoter remains personally liable unless there's a novation, a specific agreement by all parties that the promoter will be released and the corporation substituted for the promoter. If y'all are getting promoter questions right, that's a good sign. Remember who you're competing with. You're competing with students who don't know this stuff at all and they're taking wild guesses. So like if you can just have if and you know if you just have some semblance of what's going on and you don't feel like you're totally lost, that's a good sign. This is a really tough subject. I have a student, Joel, who did really, really well in this subject. I think he got a 26 out of 30, and that was a few years ago. He has his outline in the classroom that I would go through and I would look at and try to learn from and, try to mimic his study habits because he did amazingly well on this section. It is a possible section to do very well on. It's a tough section, but you could shine if you put in the work. So shareholder derivative suits. A derivative suit is one brought by a shareholder to enforce a corporate cause of action when the board of directors for some reason has not sought to enforce the corporation's rights. The shareholder must first make a demand on the directors that they prosecute the suit. The shareholder must wait 90 days before bringing the suit unless the shareholder is notified sooner that the demand has been rejected or delay will cause irreparable injury. If the corporation commences an investigation and charges, the court may stay any proceeding for such period as the court deems appropriate. To be eligible to bring a suit, the shareholder must have owned stock in the corporation at the time the action commences and when the alleged wrong took place. They could test you on that. Like if you buy stock on Tuesday and you're trying to sue for wrong that occurred on Monday, you aren't going to have standing because you didn't own stock the day that the you know, alleged wrong took place. On motion by the corporation, the court may dismiss a derivative proceeding if the court finds that one of the following groups has made a good faith determination after concluding a reasonable investigation that maintenance of the derivative suit is not in the best interest of the corporation. A majority vote of qualified directors, if the qualified directors constitute a quorum. Remember, a quorum is the minimum number of directors we need to hold a vote, and qualified directors mean people who are not, they don't have an interest in the matter. A majority vote of committee consisting of two or more qualified directors appointed by a majority vote of the qualified directors, regardless of the quorum, or a panel of one or more disinterested, independent, individual persons appointed by the court upon motion of the corporation. So even if you sue them and say, hey, if you file a derivative suit and are like, hey, company, we need to do this action, they could say, no, we don't, if they have any of these situations occur. So mergers and consolidations. So consolidations is when two or more companies combine into a new corporation. So A and B consolidate to form C, consolidation. A statutory merger is when one corporation is acquired by another, the target company is absorbed. The plan must be adopted by the board of directors and approved by shareholders of both corporations. So the acquiring and the target company both need a shareholder approval. Think about it like Pac-Man eating the little ghost. Like one company is going to survive and the other will get absorbed. Then I told you there's other forms of merger, a short form merger, when a parent company owns at least 80%, no shareholder approval is necessary. They're pretty much taking on one of their babies. A triangular merger is acquiring company creates a subsidiary, which is then merged with the target company, right? So like A creates subsidiary B, and then we merge B and C together. Now, if the subsidiary survives, it's a forward triangular merger. So if B survives, it's a forward triangular merger, and the target company survives, it's a reverse triangular merger. So now A survives, that'd be a reverse triangular merger. If you understand a reverse triangular merger, you're high level. Like a lot of this is just if you understand some of the basic fundamentals, you do the practice questions, you'll do fine. But I'm trying to prepare y'all for top tier scores. So de facto mergers, when one company buys all the shares of another company, the surviving company is liable for all debts of a target company. Shareholders receive the rights of a statutory merger. I think that's what Elon, I mean, I haven't looked into it. I don't really care, but I think that's what Elon did when he acquired Twitter. He just bought all their shares. There wasn't like a formal uh I don't know what company he had, but SpaceX is buying Twitter. Like I don't know exactly, but that's probably what happened. He was like, "Oh, I got billions of dollars. I'm just going to buy all their shares and now look at me in the company." And then share exchange, when some uh, or all the shares of one corporation are exchanged for some or all the shares of another corporation. However, neither corporation ceases to exist. So, we're just exchanging shares. It is what it sounds like. Dissolution, so a voluntary dissolution, a corporation may voluntarily liquidate and dissolve at any time without judicial supervision. Notice must be given to all known creditors. In Florida, the articles of dissolution are not filed until the liquidation has been completed. So voluntary dissolution is when they're going to voluntarily dissolve. Involuntary dissolution, any shareholder can bring an action to have the corporation involuntarily liquidated and dissolved if there's a deadlock of the directors and the corporation is threatened with irreparable injury. Usually that's a closed corporation, like a very small corporation. The shareholders are deadlocked in voting power and unable to elect successor directors. There's waste or misappropriation of corporate assets, or the directors or those involved in the corporation are acting, will act, or have acted illegally or fraudulently. So we did two practice questions. One, there was a deadlock. One, there was, illegal conduct. And these were both means for involuntary dissolution, judicial dissolution. Rules and regulations. I mean, again, when I took the Florida bar, they asked a question about blue sky laws, and I think Sarbanes-Oxley. So that's why I put them on here. It was from personal memory. Like, they do test some tough stuff, right? There's a reason why Florida has the reputation it does. But remember, I had a student at the beginning of class, a former student named Alexa, and she said, she was freaking out about Florida and she felt great about the MBE. Results came out, she crushed Florida and, barely passed the MBE. It just goes to show that Florida is a tougher test, but people tend to do better on it. Where the MBE is like a more, predictable test, but it's actually harder to do really well on, if that makes sense to y'all. So like, yes, Florida, the material is more expansive and the way it's tested, I think, is more difficult. And like overall, pound for pound, apples to apples, I think of the Florida bar exam part A is harder than part B. But apples to oranges, I feel like of my students, and just in general, I get a lot of students from other companies that didn't work out for them. Most people come to me and are like, yeah, I passed Florida, but I didn't pass the MBE. Like right now, in my boot camp, there's way more students who are only sitting for MBE because they passed part A than those who are just sitting for Florida because they already passed part B. So like, yes, Florida is harder material, but the curve tends to work in your favor. The curve tends to work in your favor, and like, do your best. But there are very hard questions on the Florida bar exam, but it doesn't mean it's a hard test to pass, if that makes sense. It's a hard test, but I don't think it's a hard test to pass. Whereas the MBE, I think, is a harder test to pass. But in general, we're all passing. You guys are rocking with the top team in bar prep, and there's no reason that y'all shouldn't pass. We're overly prepared. We're going to overperform 100%. Okay, rules and regulations. So the Act of 1933, this is what basically is known as the Paper Act, Truth and Securities Act, the Prospectus Act. It means if there's going to be an IPO, initial public offering, or an APO, alternate public offering, or an SPO, a subsequent public offering, if there's any of these public offerings where they're issuing shares, they need to provide a prospectus. A prospectus is like, hey, this is my company, Ibis Prep. This is the sales we've done. This is my team. This is what we do. You got to tell your investors, because you can see 1933, it's 4 years after 1929. Did anyone remember what happened in 1929? Any of you alive back then? It was the Great Depression. The stock market crashed. A lot of reasons why the stock market crashed. I got still things to do tonight, so I'm not going to explain every reason. But one of them was because people were selling some woo-ha, right? They were selling that, hey, this is my company, and you were really in your garage, twiddling your thumbs, but you were acting like you're a great company. Now, 1933 requires the, registration with the SEC, the Securities Exchange Commission, and sending a prospectus. The Act of 1934 is what regulates broker dealers and things like that, and usually leads to FINRA registration and such. But if you see 1933, it's the act that requires a prospectus with IPOs and registration with the SEC, Securities Exchange Commission. Exemptions to registration. So these are, exempt securities, Reg D private placements, right? Very small private placements, Reg A plus small offerings, almost like not crowdfunding, but just above crowdfunding, government issues, municipal issues, religious and charitable offerings, Rule 506, accredited investors. Accredited investors are people who have a lot of money and high net worth. And then Rule 504, limited offerings. They're exempt from registrations. They don't need to register with the SEC or comply with the Act of 1933. Rule 10b-5, again, I remember this being tested on my exam. Insider trading. Elements of insider trading claim are misrepresentation or omission, improper conduct, and proximate cause. An insider is anyone who learns of material non-public information or has a fiduciary duty to company. Both tippers and tippees may be liable for insider trading. So Martha Stewart, she went down for insider trading, right? Before she was cooking eggs with Snoop Dogg, she was sitting in a federal prison, right? Because she was guilty of insider trading, right? Um, Someone who has non-public information who acts upon it, or someone who has insider information and tells someone else who acts upon it, these could all impose liability under Rule 10b-5. 16b is control shares. So any officer, director, or 10% shareholder is liable for short-term profits of the company within 6 months. So this means like, okay, IBIS Prep is going public, right? Knock on wood, because one day we're going public, right? And let's say Alexis is like, and Bianca, they're, they own 20% of the company or whatever, and we go public, and then they sell their shares 2 months later to cash out. Wouldn't that be kind of fucked up, right? Because it's like, wait a minute, you're a top tier person in the company and you're already, selling it off. It shows that like you don't really believe in the company. There's some impropriety there. So control shareholders have a lockup period of 6 months where they're not allowed to sell their shares after going public. I think that's the easiest way to think of Rule 16b. Sarbanes-Oxley and Dodd-Frank, these were laws that were enacted during the Obama years. Yeah, after Enron and things like that. It might have been Bush years, but I think it was Obama years where Sarbanes-Oxley, that's the name of two legislators. They require executives and financial officers are certified that they reviewed the corporation's financial reports, that the reports are accurate, and they've listed any fraud, deficiencies, or major changes. So Sarbanes-Oxley and Dodd-Frank are laws that were enacted to prevent Enron from happening and make sure that like, there was accounting going on and there was corporate oversight. And then blue sky laws, again, I remember this being tested when I took the bar exam. Blue sky laws refer to intrastate securities. Intrastate meaning they're only sold within the state of Florida. They have to conform with blue sky laws, which are state regulations that are created to help protect investors against possible securities fraud. Because again, if you're not an interstate security, you don't have to register with the SEC, but you still have to comply with blue sky laws for intrastate securities. So any type of security being sold or offered within a state must register. They have to qualify for an exemption, right? So blue sky laws regulate intrastate securities. All right, now some definitions, always fun. Ultra Vires Act, an act that's beyond the powers conferred upon a corporation by its articles of incorporation or by the laws of the state of incorporation, right? We did a couple questions on that. Watered shares. So shares of a company that are issued at much greater value than its underlying assets, usually as part of a scheme to defraud investors. So yeah, like if they sell watered shares, that just a term that means like, they're trying to inflate the value so that other people will buy in. The business judgment rule protects the business of decisions of a director or officer as long as the director or officer acts in a reasonable manner. And in the corporate opportunity doctrine, the legal principle providing that directors, officers, and controlling shareholders of a corporation must not take for themselves any business opportunity that could benefit the corporation. We talked about that a lot. So thank you. We got this monkey doing business. I mean, if you go to Wall Street, that's what you'll see. And I know it's been a long night. I know we've had a lot going on, but I'm I believe in doing things properly and I want to leave no stone unturned. So there's one more thing I still have to do tonight. And honestly, I don't know how deep your girl Katya got into it, but it might be deep. Let's see. All right, only 7 pages. All right, that's not horrible. Okay. Last but not least, we'll do some light reading and then we'll call it a night. Well, not for me. I still got work to do, but we'll call it a class. So Florida Business Entities Questionnaire. What are the formation requirements for each type of business entity in Florida? How do they differ? So corporation files articles of incorporation with the Florida Department of State, must name the corporation, the registered agent, the incorporated, shared, authorized, and addresses. So shares authorized. That means there's 4 different types of shares. I mean, in this particular categorization, there's authorized shares, there's issued shares, there's outstanding shares, and there's treasury shares. Authorized shares are shares that are authorized in the articles of incorporation to sell. So let's say company A is authorized to sell 1,000 shares. Then they issue 500. Okay, so now they've sold 500 and they retain 500. So 500 issued, 1,000 authorized. Then let's say they're like, you know what? I don't think it's a good idea that half of our shares are in the public. Let's buy back some of our company. So they reprivatize. They buy back, let's say, 100 shares, right? 1,000 shares authorized, 500 issued, then they buy back 100. Those shares that have been issued and subsequently repurchased are known as treasury shares. And then there's outstanding shares. Outstanding shares are going to be issued minus treasury. If there's no treasury shares, then outstanding and issued will be the same. But outstanding shares are shares in the hands of the public. Issued shares are shares that have been sold. Treasury shares are shares that have been sold and then repurchased. And then authorized shares are shares that have been allotted in the articles of incorporation to issue. And if you're going to authorize more shares, then you need to amend the articles of incorporation. There's something referred to as anti-dilution rights, which are preemptive rights, meaning if I own 10 shares and they've authorized, let's say 100, right? If they're going to go back and authorize 100 more shares, then I have the preemptive right to buy 10 more shares to maintain my proportional stake in the company. That's known as anti-dilution or preemptive rights to maintain your proportional share of the company. LLCs file articles of organization. They must include a name, agent, members, managers, addresses. LLPs and LPs file certificate of limited partnership, LLP, and then GPs, no filing required, formed by intent to carry on as co-owners for profit. What is a promoter and what duties and liabilities does a promoter have? So a promoter is the person who organizes a corporation before incorporation. They have the fiduciary duties of good faith, fair disclosure, and avoid secret profits. And liability, they're personally liable in pre-incorporation contracts unless the corporation adopts them, and then there's a novation. What are subscription agreements and when are they enforceable in Florida? So pre-incorporation agreements to buy shares. In Florida, they're irrevocable for 6 months unless agreement says otherwise or all subscribers consent. So you can attach that 6-month rule to subscription agreements where you agree to keep buying shares. The AOI must include the corporate name, number of authorized shares, the registered office and agent, incorporation, the addresses. They may include the purpose, duration, limits on powers, and preemptive rights, anti-dilution rights. What is the effect of defective corporation and when can someone be personally liable? If incorporation is defective, those acting may be personally liable. De facto corporation or corporation by estoppel may protect if it's a good faith attempt, valid statute, or exercise of corporate powers. What are statutory obligations of Florida corporations after formation? Annual reports with the state, maintain registered agent, and keep books, records, and pay franchise and filing fees. What does it mean to pierce the corporate veil? So courts disregard the corporate entity to hold shareholders personally liable. It's done in exceptional cases for alter ego, no separateness, fraud or improper conduct, or undercapitalization or misuse of corporate form. What is the alter ego doctrine? So corporation used as a mere instrumentality of the shareholders. There's no separation between personal and corporate affairs. It's a basis for veil piercing. What's the deep rock doctrine and how might it apply in bankruptcy? So in bankruptcy, shareholder loans may be subordinated to outsider creditors' claims. The shareholder dominated the corporation, undercapitalized. It's just a mechanism to pay the outside lenders before the inside lenders because of impropriety. So direct versus derivative. Direct is when the shareholder sues to enforce personal rights, whereas derivative is when the shareholder sues on behalf of the corporation. They must first make a demand on directors unless it can be shown that demand is futile. What fiduciary duties are owed by directors and officers and shareholders? So directors and officers have the duty of care, duty of loyalty. Controlling shareholders have the fiduciary duty to minority shareholders when exercising control. This duty requires them to act fairly, not to oppress minority interests, and not to use their control to benefit themselves at the expense of minority shareholders. And then ordinary shareholders, ordinary non-controlling shareholders do not owe fiduciary duties to each other or to the corporation simply by virtue of share ownership. What's the business judgment rule and when does it protect corporate officers? So it presumes directors act in good faith, informed in the corporation's best interests. It protects officers, directors from liability for honest mistakes in business decisions, right? You're stuck between a rock and a hard place, you turn into the hard place, you're still going to be protected because business judgment rule. What's the corporate opportunity doctrine? So directors, officers may not usurp business opportunities within a corporation's line of business unless the corporation rejects them after full disclosure, and a breach would be a disgorgement of profits, right? If you usurp, then we're going to be able to take away the profits that you made because those profits should have gone to the corporation. So when are you entitled to inspect the corporate books? So you have a right to inspect the books and records if it's a written demand made in good faith and proper purpose. Must describe the record sought and purpose, includes accounting record, shareholder list, and meeting minutes. You can't ask for this on a Sunday at 2 in the morning, right? It has to be, at the principal place of office during work hours, right? IBIS Prep, we work around the clock. You can ask us for our books anytime. Like I said earlier, our books aren't, they're not that great. We're a lonely little tutoring company in this big world of, I don't know, people make money doing import export. That's what I wish I did. What are shareholders' rights regarding dividends and when can a corporation legally issue them? Shareholders have no rights to dividends unless declared by the board. Dividends may be paid only if the corporation can pay the debts as they come due and total assets are greater than total liabilities after distribution. Directors approving unlawful dividends may be personally liable. What's the procedure for shareholder meetings and votings under Florida law? So annual meetings are required. Special meetings may be called by the board. Holders of more than 10% shares or other that are authorized. Notice 10 to 60 days before meeting. A quorum is the majority of the outstanding shares entitled to vote unless bylaws set otherwise. Right, a quorum is usually you need a majority to have a vote. Election of directors. Directors are elected by plurality of the votes. The candidates with the most votes win, even if not majority. Ordinary business, ratification of actions, approval of minutes requires the affirmative vote of a majority of shares present in person or proxy at a meeting at which a quorum is present, unless a greater vote is required by the articles or by the bylaws. Fundamental changes like mergers, amendments to the articles, dissolution require the affirmative vote of a majority of all shares entitled to vote, not just those present, unless the articles of incorporation or bylaws require a greater vote. Voting trust, so shareholder transfers legal title to the trustee who votes shares must be in writing, signed, and filed with the corporation. So voting trust means like we're all going to put our votes into this one trust. And then a voting agreement is a contract among shareholders to vote in a certain way, enforceable like any contract. So voting trust is when like we're all going to put our votes into one, we're going to give all our votes to Tommy and Tommy's going to vote on our behalf. A voting agreement is we all agree to vote for, X. So what are the rights and obligations of shareholders during dissolution? Entitled to residual assets after the creditors are paid. They may receive liquidating distributions proportionate to shareholdings, and shareholders may approve voluntary dissolution and appoint liquidating directors. So dissociation is when a partnership leaves the partnership, but the partnership continues. A partner leaves, but the partnership continues. And dissolution is when the partnership winds up and terminates. It occurs if all partners agree, terms end, unlawful purpose, or court decree. So involuntary dissolution, fraud, abuse, illegal acts, deadlock, failure to elect directors, shareholder oppression, failure to file annual report or to pay fees. What are the rules for involuntary corporate dissolution in Florida? Requires board resolution, shareholder approval, or for voluntary dissolution. Board resolution, shareholder approval. After approval, they file the articles of dissolution with the Department of State. The corporation then winds up the business, paying debts and distributing the remaining assets. A non-for-profit corporation, known as like a B corporation. I always notice, you ever been to Just Salad? They have one in Coral Gables. That's technically a B corporation. I'm like, I wish I was Prep was a B corporation. It'd be nice, right? There's no shareholders, there's members instead, and you cannot distribute profits to members. Instead, assets are used for charitable, educational, okay, there's a route, religious or societal purposes. What types of fundamental changes require shareholder approval? Amendments to articles, mergers, share exchange, sale of substantially all assets, dissolution, right? Fundamental changes to the articles. Um, Stock splits require shareholder approval, right? A stock split means like, okay, Apple shares are selling for $1,000, right? Well, we can do a stock split like a 10 for one, where now Apple shares are going for $100 a share, and we're going to give everyone 10 shares, right? So that way it allows people to buy in, you know, it, it's because you can buy fractional shares, it doesn't really matter, but it's more for the optics. Like if you see a company, you're like, oh, these shares are going for $12,000, like you're not going to want to buy it. But if you see like, oh, Nvidia is trading for $8 a share, I could buy a few. It's kind of like that's why they have stock splits. Um, they could do a reverse too. You could have a reverse stock split where it's like you want to make the shares more valuable, and then you'll get half the shares if they double the value of the price or something like that. So what appraisal rights do dissenting shareholders have in Florida, and what's the process? So dissenting shareholders are entitled to fair payment if they object to fundamental changes. They must give written notice before the vote, abstain or vote against, or make a timely written demand after the vote. So appraisal rights, I mean, my family, my brother, my father, and my mother are appraisers for real estate. They go into houses and are like, this house is worth $1 million, right? Appraisal rights for businesses mean, they're entitled to know what their shares are worth. Now, do you have appraisal rights for if you own Apple, Nvidia, or Google, Alphabet? The answer is probably no, because it trades on the open market. You know what your shares are worth. Just go Google, price of Apple stock. But if it's like a smaller company, a closely held company, then you do have the right to be like, hey, how much are my shares worth? Um, my family had a situation like that where my grandfather had shares of this bank in Miami that he was a lawyer and helped them, helped them along. And my uncle had the shares, and we had no idea what the shares were worth, and they didn't really want to tell us, but you know. That's my uncle's windfall, not mine. What is a merger, a share exchange, and a sale of assets? I guess my mom's too, right? What's a merger, a share exchange, and a sale of assets, and how are they treated in Florida law? So, a merger, two corporations combine, one survives, requires board and shareholder approval. A share exchange, one corporation acquires shares of another, similar approval. And then a sale of substantially all assets requires shareholder approval, but not dissolution. What are preemptive rights and how are they automatic in Florida? So the right of shareholder to maintain percent ownership by buying new issuances that's not automatic in Florida must be expressly provided in the articles. I have a friend that I went to law school with. Um, he actually is the president of this golf tournament I play in. Really cool dude, Tim. And I was helping a company when I first started my career do an operating agreement. And like any new attorney, I called my friend. I was like, yo, what should I put in his operating agreement? And he's like, make sure you put in anti-dilution rights. It's like a very important thing. And so that's something I always remember that like it's not automatic, but it should be included in foundational articles. What's a long arm jurisdiction? How can Florida courts exercise jurisdiction over a corporation? So, this is a PJ analysis. They do business in Florida, they commit a tort in Florida, they own, use, or possess property in Florida, they contract to insure in Florida, or they otherwise fall within the enumerated acts. What are the Florida blue sky laws? So, requires registration of securities offered in Florida unless exempt, protect against fraud and security sale, and differs from federal law because it focuses on intrastate transactions and smaller offerings. So, blue sky laws are associated with intrastate sales just within the state. You can probably get that question right in the test if you just know that. What is insider trading? So breach of fiduciary duty using material non-public information. I'm glad she identified what that meant. Florida's special facts doctrine. Directors must disclose material facts when dealing with shareholders or rescission damages may follow. So yeah, they have to disclose material facts when dealing with shareholders or rescission damages may follow. 16B, it's the 6 month rule I was telling you about. So control shares, 10% shareholders or officer directors must disgorge short swing profits from buying or selling public corp stock within 6 months. Strict liability intent is irrelevant, right? You pretty much have to hold your shares for the first 6 months if you are a director, an officer, or a control shareholder. 10b-5 prohibits fraud, misrepresentation in connection with securities purchase and sale. So the elements would be misrepresentation, omission of material fact, scienter, intent, recklessness, reliance, causation, damages, and instrumentality of interstate commerce. So, it's very related to the insider trading and things like that, Rule 10b-5. What's a tender offer and what federal laws apply to it? So a public offer to buy shares from a shareholder at a premium governed by the Williams Act, the 1934 Exchange Act amendments, and requires disclosure of identity, financing, and purpose. There's something called the poison pill doctrine where you can, uh, fight against a tender offer by labeling certain shares as poison. I never saw this in life. And then I just read an article like 3 days ago on ESPN of all places talking about a contract that had a poison pill provision. I was like, that's the last place I expected to see that. But don't worry, you guys don't need to know about poison pill. It's not going to be tested. If it is, let me know and I'll tell my class next time. But I don't think it'll be tested. So how is agency created and what types of authority exist? Actual, apparent, inherent. Like I said, consent of principal, agent, and controlled by the principal. So principal agent relationship, the agent is acting on behalf of the principal. Authority could be actual, express, or implied. Apparent, the principal holds out as an agent, or inherent, it does usual acts for the position, like the manager of the rock and roll band. When is the principal liable for the torts of an agent under a spinal superior? The principal is liable if the agent is an employee, not an independent contractor, and the tort committed within the scope of employment. An independent contractor, principal is usually not liable except for inherently dangerous activities or non-deductible duties. You probably learned that from torts. What do agents and principals owe to each other? So the agent owes the principal loyalty, care, obedience, accounting, and disclosure, and the principal owes the agent compensation, reimbursement, identification, safe working conditions. So, if Tommy's working for me, I'm the principal, he's the agent. Tommy, buys pizza for our clients. I got to pay him back for the pizza, right? What's the difference between detour and a frolic? So detour is a minor deviation from the scope. The principal will be liable, where frolic is a substantial deviation for personal purpose, and the principal is not liable. This is grabbing a cup of coffee while doing a delivery. This is going to your girlfriend's house and frolicking in the fields. Well, whatever. So what's the difference between employee and independent contractor? So again, it's interesting because like I technically don't have any employees. Everyone who works for me is an independent contractor. They could probably pierce that and say that I do have employees because of the nature of some of the people who work for me based on, you know, the relationship. So just because you call someone an independent contractor and you pay them, as a 1099 employee doesn't necessarily mean that they're not an employee under the law for the sake of liability. You have to look at like the relationship between the parties. So the employee is principal liable for torts in scope and independent contractor, no vicarious liability, exceptions to be non duty and inherently dangerous activities. And then finally, last but certainly not least, what is a business trust and how is it formed to operate in Florida? So, business trust is created by a written declaration of a trust filed with the Florida Department of State. The trustees manage property business for the benefit of certificate holders who are beneficiaries, and they're treated as a legal entity like a corporation for suing or being sued. That would be a business trust, is like, you have to file, it's managed like a business, and it's treated as a legal entity. So, I know this was probably the longest class of the year. I can see your faces, but it's because I think it's an important subject, and you want to be prepared for it. There's partnerships and corporations. They're two distinct facts. Remember, general partners, limited partnerships, LLPs, PCs, professional corporations, things like that, and then um, C corps, S corps, LLCs, right? All these different types of entities that could potentially be tested. But this is just the main part of the subject. They will also test within this realm secure transactions and commercial paper, Article 3 and Article 9. We're going to be doing them on Wednesday. And I'll be honest, those subjects are a lot easier. That class will be a lot more simple. It's just, some key fundamental points. Whereas if you were going to ask me what is the widest subject on the bar, I would say it's business entities because corporate law is a huge thing. And, it's kind of hard to pinpoint exactly what's going to be tested, but I recommend everyone do the practice questions and try to make heads or tails of what we discussed today and just do your best, right? Like if you learned anything today, it was productive. I really appreciate everyone for hanging out with me tonight. I'm going to go ahead and stop this recording.